Hey guys, welcome back to the Hilton True Wealth Podcast, the show where we explore the ideas, strategies, and conversations that help people build meaningful, lasting wealth, not just financially, but in life. I'm Mark Miller, manager of the Hilton Family Office and CEO of Hilton Tax and Wealth. Today, I'm joined by Jason Plusanak, Senior Investment Officer of the Hilton Family Office. Jason has over 20 years of experience in investment management, specialty finance, and manager operations. We'll be discussing retail investing and what we call smart money investing, the strategies used by institutional investors and family offices that most people never hear about. So Jason, welcome today.
Thank you.
Thanks for being here. We
Happy to be
appreciate
here.
it. So most investors, they kind of follow a traditional path, stocks, bonds, mutual funds, that kind of boring stuff, so to speak. But institutional investors operate in kind of a completely different realm, completely different universe for that fact. So in your experience, what's the biggest difference between how everyday investors invest and how institutional investors invest?
Sure. Good question. And I would also include family offices
Yes.
in with institutions. I think the biggest difference between the two, I would say, is really approach and access, the two key things. And what I mean by that is institutions and family offices, like at the Hilton Family Office, we approach the investment process in a very detailed manner. We have processes, risk management analysis, and really a low emotional or behavioral aspect to investing, meaning it's our business.
Right.
This is what family offices do. So that approach to investing is very different than the retail mindset, like you asked, where we most commonly see behavioral patterns, emotional decision making, etc. And that's normal. I mean, people are people. They're going to make emotional decisions or act in a behavioral pattern that mimics the crowd, if you will, herd mentality. We'll probably talk about that a few times today.
Yes.
But that's the biggest difference in the approach. In regards to access, that's all about investment products. Institutions, family offices having access to off-market deals, private equity, tax-advantaged strategies that the retail investor doesn't know about or maybe doesn't know how to access. So approach and access, those are the two keys I think are the biggest difference between the two.
Right. And I think what's really interesting too about the Hilton Family Office is we also have proprietary offerings and things available that aren't even often in the family office universe that are special.
We are lucky in that way, Mark.
Yes. Yes.
But that's a good point.
Yeah.
You know, the family office network, though small, is also bifurcated in the way of a big name. And as we know, Hilton is a very big name. So even in the family office space, families like the Rockefellers, Hiltons, etc., do get access to investment deal flow that even other family offices don't get.
Yeah. And yeah, that's what makes our family office, I think, very special in that sense. So going back to kind of traditional investing, because our book Hilton Wealth kind of talks about kind of being stuck in that mindset. And mindset is a big thing, and I'm going to have we'll talk some more about it, but I'm going to have a whole episode on that and kind of letting your the mind gets in the way and the emotions get in the way of good rational decision making. Yeah. So do you believe that most investors realize or even know that there's a different way to invest out there?
You know, this might surprise you, but I think yes.
Yeah.
I actually do think they do know, understand, and or realize that there's a bigger, better way.
Yeah.
They just don't or can't get to it.
Right. Access that you were talking
Yeah,
about.
I really do think it comes down to the access. And, you know, everyone knows it's out there. They know family offices and institutions are investing in all these neat private things that they can't get to, but they don't realize how to get that access.
Yeah. It seems to me that's kind of the biggest thing too. It's just a lot of people that we start working with at first, and they may be very wealthy, but they're still stuck because sometimes they got wealthy going through that retail, how retail wanted them to paying all those extra fees, dealing with all the volatility, all of that type of thing. Those same types of things generally the smart money folks don't have to deal with as much. And they get to these certain levels and they're still in that place, and we need to kind of educate them about, hey, you need to make this mind shift. But to your point, they also kind of know that there's a better way. Yeah, because they're like, why can't I sleep at night? Why can't why are all these things happening to me when I feel like I've got plenty of money and they shouldn't be happening to me?
Right. That's totally right. So it's out there. Most people know it's out there, especially affluent investors. It's all about finding access and finding a group you can trust.
Yeah. So let's talk a little bit and go deeper into alternative investments. Now, one of the things that we talk about in the book Hilton Wealth is the role of alternative investments in a portfolio. Why do institutional investors allocate so heavily into alternatives, do you think?
Well, I'll tell you what I know. I've actually spent the last 20 plus years of my career in alternative investments, structuring them, building companies, raising capital to invest into alternatives specifically. Primarily, it really comes down to non-correlated returns, investment returns that are non-correlated to the traditional stock and bond markets. Generally lower volatility, which is a good thing in most cases, but also the opportunity for higher returns in alternatives. And you wouldn't think of those two things going together, lower volatility and higher returns. Most people think, it's got to be really volatile. You got to take a lot of risk. It's got to be highly volatile to get the asymmetrical returns. Generally not the case with alternatives if structured correctly and invested in correctly.
Yeah. And I think one of the things that we've tried to do in the Hilton family office that is different even than a lot of other family offices too, is when we look at different offerings or different deals to bring in, often we want to find those folks that will also give us maybe some backstops on those alternatives. I talk to my clients all the time about this because when you think of alternative investments, you do think of very high yields. Well, sometimes, and you'll see this all the time, people are in things where, boy, I sure hope this goes. I hope this oil well goes, or this development goes, or whatever, and they're in it completely naked. And I think one of the unique things that we're doing, and you might want to expound upon this, is making sure that we structure things to where we have incredible relationships. First of all, we know the people very well that we're getting involved with, and that they're able to give us some assurances that if we bring money forward, that they can give us some backstops, whether it's by assets or whatever. But expound upon that a little bit.
Yeah. To your first point, I think we're lucky in a sense where not only are asset sponsors or investment product firms happy and lucky to get capital, they actually want to take care of those important investors who do come in, such as the Hilton family office. And what I mean by that is, we are sometimes able to get better structures, better assurances from the investment sponsors because the money is coming from the Hilton family office and affiliates, if you will.
Right.
That generally means, again, lower volatility, maybe some better floor returns, if you will, but still the possibility for the upside.
Yes.
Right. Which is what
to
we
keep
want.
that intact. Obviously, we want that part of it, but we generally want some assurances too, just because we're very risk averse. I mean, that's the bottom line. We're very risk averse, and I think that's super important, especially in the environment that we're in today in the markets. So, what are the advantages that private investments you feel might have over public market investments?
It's really the same. It's the same. The advantages are the same as the reasons why people invest in them. Lower volatility, non-correlation to traditional markets, but still the asymmetrical upside return possibility.
Right.
Yeah, it's the exact same, I'd say.
Yeah. And where would you see the biggest opportunities in the kind of investment environment, exciting, really, investment environment that we are in today?
Yeah, it's an interesting time. Global conflicts, right? Interest rate environment. There's a lot of, and there's always a lot of factors. The talking heads on the media channels can rally you up every single day of every week, of every month, of every year.
Right.
And they have. But there are truly some dynamic things going on around the world right now. One thing that comes to mind to answer your question actually revolves around energy, whether that be traditional energy, natural gas, oil mining, etc. The other thing in regards to that is rare earth minerals. We found out recently in regards to rare earth minerals, and I'm talking metals, things we use every day that are in everything we have and we use. We're talking about our watches, our laptops.
Wait, aren't you talking about oil? Everything that we walk on and have access to is oil. But anyway.
You're absolutely right. To this microphone, petroleum is in so many products we don't understand.
Yeah. Yeah.
It's wild. So, with geopolitical conflicts, Venezuela, Iran, I really believe a lot of it revolves around China's control over the products that go into making things and go into producing energy.
Yes.
So I think a big opportunity in the alternative landscape right now is looking and finding access into some of those energy providers, mining operations, rare earth minerals. It's wild. I mean, the metals and magnetics that go into everything, China controls 90% of the market, the global market.
Right.
Even things that the United States Defense Department uses and needs to do what it does. So, at the Hilton Family Office, we're looking heavily into energy and minerals. It's a big space. There's others, of course.
Sure.
We're always keeping an eye on early stage real estate development. That cycles more than others. But we like to keep an eye on it and look for opportunities when others aren't excited about it. That's another, aspect between long-term investing and maybe retail investing is
Sure.
We're not necessarily following media hypes or the next hot thing.
Yeah.
We've got a disciplined approach, and we like to look at things when they're not being talked about, when they're not exciting.
Sure. And I kind of think, and I really believe the more I read, the more I see out there that we are maybe in the most dynamic and exciting time in world investment history. I'm not just saying.
I don't disagree.
Obviously that's a lot of things and a long time and a lot of cycles. But when you look at what's happening with AI, when you look at what's happening, with blockchain, when you look at what's happening in robotics, biosciences, all that. Now, a lot of this is driven by AI. And of course, at the Hilton Family Office, we're really on the cutting edge and the forefront of digital assets, which obviously is part of blockchain, kind of goes one and one together. But
yeah, you're absolutely right.
Yeah.
The technology sector is, at a place we probably haven't seen since the late 90s as far as disruptible capability, AI, blockchain, robotics, etc. And technology is certainly a area the Hilton Family Office is focused on. Mr. J. Bradley Hilton is very keen on technology, as we both know.
yes, absolutely.
If we're talking graphene, if we're talking blockchain, digital assets, it's something we are always having an eye on.
Yeah. And I think it's really about the future. I mean, we're in a revolution right now. And again, I think a lot of that's just going to be driven by AI. And we're seeing that with a lot of the companies that we're working with, seeing how AI is changing what they're doing. It's speeding up how they come to solutions and things of that nature. So yeah, it's an exciting area. And it's one of the areas, I mean, I think that excites us most. When we're at conferences, family office conferences, things too, it's like what people are talking about. The kind of just this changing world and then changing technologies, which is huge. So let's switch gears here a little bit and tell me, why do you think the wealthiest families tend to think much longer term than, say, the average investor?
Well, one reason is probably the number on the balance sheet. Another reason would be expectation. And I think just the family mandate, if you will, they start looking at investing in their investments as its own living organism, if you will. Like this entity, this wealth needs to outlast us.
Yes.
So I think it's expectations and, well, again, the number on the balance sheet definitely has something to do with it.
Yeah, I mean, I find that there's more of an emphasis on, I think a lot of people view ultra wealthy families like they're just doing these crazy investments. And they're making all this money, doing all this crazy stuff. But it's when people get to a certain point, they start thinking more about legacy. And well, if you're thinking about legacy, you have to think about preservation. Otherwise, there is going to be no legacy.
Right.
If you're just taking all these wild risks. I always tell everybody too is that it's you don't often see, if somebody makes the Forbes richest list, you don't see that there's all these people coming in and out of that list. They usually stay on that list.
That's a great point.
You're
absolutely right.
Yeah, they're not staying on that list because they're taking wild investments that one year they can be off and the next year they're on. They are, you always talk about Warren Buffett. People think that Warren Buffett is just invested in Berkshire Hathaway and he's invested in these companies that are going up and down in value, but a good percentage of his portfolio is invested in very safe, secure investments to protect that legacy.
Yeah, I think you make a great point in regards to most people thinking that institutions and family offices are investing in, esoteric, wild strategies that nobody knows about, et cetera. But that's, while it may be true in some small cases, by and large, that's not true.
Yeah.
They are more focused on legacy, preservation of assets, collateralization, asset-backed assurances, things of that nature.
You bet. And so, why is it that long-term mindset generally leads to better outcomes in investing?
I believe it's because it eliminates short-term emotional decision-making, which is hard not to do as a retail investor when we're getting messaging and advertisements and people yelling at us or
Stuff
social media
all over the place,
all over
everywhere.
24/7.
Yeah,
24/7.
Yeah.
So that longer term mind, folding into a group or a shop that can help bring that long term. And when it comes to financial service firms, I mean, a family office is really an ideal situation because that is the longest of long term viewpoint, right?
Yes.
They truly want their family's wealth to last forever.
Yes.
And coming from that position provides strategies and a fiduciary mindset around the assets themselves.
Right. So what generally happens when folks focus on that noise too much?
Bad things.
Bad things. Seems like never good things.
Yeah.
Yes.
Bad things.
And so when you look at then overall, so the smart money, how the smart money invests, then would you say is probably the biggest thing is that they just try to eliminate as much emotion as they possibly can out of the picture?
I think so.
Yeah.
Ideally, right? And that comes back to your very first question today. Approach. The approach to investing is systematized with risk management analysis, due diligence checklists. It's the approach tries to eliminate as much emotional and behavioral decision making as possible.
Absolutely, yeah. So what I find a lot of times people come to us, they've been investing in the retail side for a number of years. Now, don't get me wrong, because we've worked with at Hilton Tax and Wealth Advisors. I mean, we work with folks that have 500,000 and 100 million, all over the spectrum and that type of thing. But what I found is that the sweet spot is about 10, 15, maybe 20 million. They'll come to us, they'll have been on the retail side and they have stuff everywhere. Mm-hmm. And because they don't know, they think that and just naturally they've gotten into this mode that, well, if I got more money, I got to do this and got to do that. And you got to and I need to be in more investments and all of that. The reality of it is that the folks we work with in the Hilton Family Office, generally, we're trying to help them simplify and make things. And that's one of the things that our podcast is going to be about in various episodes that you all will I'm hoping you'll subscribe and listen to weekly. Definitely, that we'll be talking about, how do you combat against getting too much and not simplifying, because when you simplify, it makes your wealth building easier and more efficient.
Yeah.
And that's the thing that people a lot of times don't get to about. It's not sometimes wealthy people, but they're good at what they're doing. They're simplifying things, and that way they can have a little bit more financial peace and peace in their life in general.
You know what this makes me think of? It makes me think of moving and your house and your belongings, right? So, you get married, you start a family, you start accumulating things in your house, right? Mm-hmm. And career's going good, you start doing better, you have investments, things are going well, and you just generally accumulate, and you never realize how much clutter and stuff you have until you move, right? Until you move. And what happens when you move? I mean, you're pulling stuff out of everywhere.
Why do I have this? Why do I have that? And
right?
I don't need this. I don't need that. Yeah.
So what you're mentioning made me think about that, because it's almost like coming up with a checkpoint in life where financially you clean house. Mm-hmm. Right?
Yeah.
And I don't necessarily mean actually, eliminate all these investments and make major changes. But cleaning house, theoretically, can simplify your life and can focus your financial assets to where they should be, rather than just spreading them out more because you have more money to spend.
Yes, absolutely. And leading to true wealth. That's
right.
Definitely. So a few rapid fire questions here. Mm-hmm. So what do you think is the biggest investing myth?
I think it's that you have to be an expert to do well at investing. I think people think you have to be insanely smart, have a ton of hours to be able to do it, to be successful. But I think that's a myth. I think you just need to find an expert.
Yeah, that's a good
Who
point.
can do that for you.
Yeah.
And build trust, of course, who you trust.
Yeah, that's great.
That's what I'd say.
How about one investment people misunderstand?
I would say the simplest ones. I believe that the simplest investments that most people own are ones they don't fully understand when it comes to fees, commissions, trails, things of that nature.
Are you talking like maybe mutual funds?
Mutual fund, yes. Mutual funds,
yeah.
ETFs, everything in their 401k.
Yes.
I think most people do not understand the simplest investments that they hold.
Yeah, that's a great point, because I talk to clients all the time too about they don't understand the fees in mutual funds. They might see like, and not to pick on Vanguard because it's good company or Fidelity, whatever, but they'll say, hey, you're only paying 0.5% here or 0.25%. They have no idea what's built in the fees that are built in to the mutual fund system. So both internal and external fees. And so I used to have a friend that built a mutual fund company, had 4 funds, and he told me that every year he would clear 4%. So, and by the way, that doesn't mean that he was just that's just an off thing, that it was just him doing that and taking 4% from people. That's pretty much what mutual funds are clearing in general.
Unbelievable. Really.
Yeah. I mean,
it's unbelievable.
And I always say, do you really think that Fidelity builds all those gigantic skyscrapers in Manhattan with a 0.5% on your money?
Good point.
Yeah.
Good point.
So they're making tons of money. The market makers are making money, all of that. So that's a really good point. What should investors stop doing immediately?
I would say stop acting on social media advertisements. Meaning, again, back to 24/7 media, social media, accessibility, advertisements. It's in our face all the time. And I believe retail investors should stop acting on those things on a whim. All of those messages have teams of people designing the language and how it's said and the visuals to psychologically hook you, to hook me, to make people act. So you're really falling into advertising genius when you're acting on those things.
And you know what I say is, you don't have a chance.
You really don't.
Seriously, when you've got the smartest people in the world, there was just a landmark case that came where Meta and I think Google are now getting, they actually were found liable. And it's because, and apply some common sense too. We know that, again, these people are the best and the smartest people in the world, and we know that these platforms can be addictive and they can manipulate things. And sometimes I think they manipulate things. Maybe the teams inside kind of unknowingly, but they are just because of the structure that they have and how they're getting information out there to people on their platforms that are extremely addictive.
Yeah, that's right. So, rather than acting on those things from those teams doing that, I think most people should find a team spending that kind of time, care, and expertise into the investments they're researching.
Yes.
Right?
Yeah, absolutely. So last question. If someone's listening today, they wanted to start investing more like the smart money folks do, what would be that first step they should probably take to do that?
My first thought would be to compile your entire portfolio and talk to an expert.
Yeah.
That's what it would be. It wouldn't be anything on your own. Everyone benefits from speaking to other people,
right?
Particularly when it comes to complexities. And your wealth, your family's wealth, is one of the most important things in your life. Not the money itself, but what it can do for you, your family, and your mentality. So talking to an expert would be the first thing I'd say.
Absolutely. And I don't think Jason says that in a biased way. It's only because we've been in the business a long time. And I mean, statistics will show, and they do play out, that the average kind of do-it-yourself investor has a lot of ups and downs, will only generally make about 2% per year on their money. And so they get 20 years into it and they're wondering, why have I not made any progress here? And it's because maybe they didn't ask for the right help or didn't ask somebody to help. It doesn't mean they shouldn't do any of it themselves.
Sure.
But they need some help. And I think another thing probably is, in kind of the information revolution, it's made people think more and more, since there's so much information out there, I can do it myself for sure. Mm-hmm. Strangely enough, just like you were talking about, there's so much information out there and it's so easy to get
It's analysis
taken
paralysis.
away. Yeah, taken away by that. Yeah. We have that. We have that a lot too. Where I mean, even the expertise and the massive expertise that we have over time. I don't say that in a boastful way. I'm just saying it's about time. It's about access. It's about being around this and living and breathing it every day. And yet we might give recommendations and someone will go, well, let me do my due diligence on that. Let me go to the internet.
Right.
Yeah. That, and then they come back with 10 things. Well, the internet says this and this and this and this. And then it's like, okay, then you're arguing with the internet, which is insane, but
it's a black hole.
Yeah, totally.
Never ending.
Well, great conversation today, and I look forward to further conversations. And we so much appreciate you helping so much in the investment side of the Hilton Family Office.
Happy to be here.
All right,
Thanks
great.
so much, Mark.
That brings us to the end of today's episode of Hilton True Wealth. If you want to learn more about the topics relating to building your wealth, tax planning, cutting edge technology, and the family office services, we're always here to help. A huge thank you to Jason for joining us today, and be sure to follow us wherever you get your podcasts so you never miss an episode. If you found value in what you heard today, share it with someone who might benefit too. For more insights, resources, and to get a free copy of our book, Hilton Wealth, How to Invest Like an American Dynasty, visit us at hiltonwealth.com. Thanks for joining us today. Until next time, keep learning, keep growing, and keep building your true wealth.